To make a move like that, you have to have kahunas and conviction.
Long term, I'm bullish. We could see about a 20% correction next year.
This is Josh Jalinski, the financial quarterback. Don't touch that dial. This is Josh Jalinski, the financial quarterback. You can follow my podcast. This will also re-air as a podcast. Try to get this up quickly because it's timely stuff. If you have a question for George, you can request to be a speaker, or you can message me and I'll ask his questions. But I want to know about the Sahm Rule. I've heard about this for years.
Yeah.
Is this legit?
Yeah.
And
Yeah,
what
well,
is it first? Go ahead.
It's got a 100% accuracy going back to the 1950s. So when the Sahm Rule is triggered, we are either in a recession or very, very, very close to a recession. So I think it's got quite a bit of power. I think the only reason that I wouldn't fully subscribe to it is a lot of people think that when you trigger the Sahm Rule, that means you're going to have a recession. And what they don't realize is a lot of times when the Sahm Rule is triggered, you're already in a recession. But that's just me nitpicking. I mean, as an overall indicator, I think it's incredible.
Yeah. Well, do you think we're in a recession, or do you think we're going into a recession?
I would say, based on, I mean, let's just talk about NBER, what they're going to claim as a recession. Looking at it through that lens, I don't think we're there yet. I think, that first quarter of negative real GDP growth, that's when they'll say this was the recession, but they always do this in hindsight. They always do this like a year later. I mean, going back to the GFC, remember they came out in December of 2008, and finally said, oh yeah, by the way, we have been in a recession since January of 2008. So basically, 11, 12 months later, it's like, oh yeah, by the way, guys, we were telling you that you're a tinfoil hatter and you're spreading misinformation and disinformation if you're talking about a inverted yield curve leading to a recession, but you were actually right. Anyway, oh look, a squirrel. That's what they do every single time. And I would assume this is exactly what they'll do this time as well, especially with an election year. I mean, the Biden administration is going to want to make sure that the NBER is not coming out and saying that we are in a recession unless the evidence is so overwhelming they can't even help it, like during the COVID lockdowns or something like that. In my opinion, it's just a matter of when. It's not really a matter of if. And what we have seen pretty much since we got that soft CPI rating or CPI read the other day, to me, the market is waking up to this, because I always say on my channel that we go through these cycles where bad news is good news only to a certain point, because we get the data that's becoming soft, unemployment rates going up. We see all this news from Starbucks saying Americans can't even afford coffee anymore. McDonald's coming out and saying that $5 value menu didn't even move the needle, and that they're still trying to attract a low-end customer. And if that doesn't do it, what does? And the fact of the matter is that those Americans are just broke. I mean, they've had their purchasing power decrease since 2019. Sure, their nominal wages have gone up, but so what? If the rate of inflation or the prices of the stuff that you buy daily is going up at a faster rate. And we've been able to kick the can down the road, but the lack of purchasing power, the decline in purchasing power for the average American is now coming to the surface, and it's time to pay the fiddler. And the market is waking up to the fact that, oh, wait a minute, lower interest rates aren't necessarily stimulus. Oh, wait, lower interest rates aren't actually a good thing. They're a bad thing. They're a bad thing, because the reason we have lower interest rates, the reason the Fed is going to raise rates, isn't because we're getting a no landing or a soft landing, and they're just magically bringing the inflation rate down to their 2% target while the economy is booming. No, it means that the economy is collapsing, that the economy is going through some very, very difficult periods, which even if they lower rates, isn't going to move the needle. And the market, and it's when the market goes from this narrative of bad news being good news to you get that paradigm shift where the market wakes up and realizes bad news is actually bad news. And I think we started to see that when we got that soft CPI print the other day, and the NASDAQ tanked when you would expect it to go up. And then we got the market confirmed that when Powell came out on Wednesday and gave a very dovish press conference. The market absorbed that, and you would expect to see the stock market go higher because he's dovish, right? And lower interest rates means higher stock market. But then we saw the exact opposite. And yesterday, even after the market was pricing in what Powell said, we still saw significant declines. And today we saw just, well, I mean, the market's only down by 600 points, which in percentage terms isn't a lot. But when you think about what it's telling you, the signal that it's telling you, combined with what we're seeing in interest rates, that's where the move has been profound. It's not just in the stock market. It's in interest rates. When you look at the 2-year, when you look at the 10-year, when you look at the 30-year, when you look at the curve starting to uninvert due to a bull steepener, that's the real story here.
Explain that for people who don't know what you're talking about.
So the curve inverts before we get a recession. This has happened every single time going back to the 1950s, where the inverted yield curve has preceded every single recession hard landing we have had. But the hard landing of the recession very rarely happens when the curve is inverted. It's when the curve uninverts. And it's very important to distinguish between the two ways the curve can uninvert. Number one, you've got a bear steepener, and I'll explain this in a moment. And number two, you've got a bull steepener. So the curve inverts when the long-term interest rates go below short-term interest rates, which if you just think about that logically, it doesn't make any sense. Because if I'm going to loan you $1,000 for a week compared to, let's say, 10 years, I've got far, far more risk in loaning you that $1,000 for 10 years, and therefore I'm going to charge you a higher interest rate. That's why the curve naturally is steep, meaning short-term interest rates are lower than long-term interest rates. So when that curve inverts, it's very atypical. It tells you there's something fundamentally wrong with the economy. So then what happens is the curve eventually steepens out again to where long-term interest rates are higher than low-term interest rates or shorter-term interest rates. But that can happen one of two ways. You can have a bear steepener, and that's when, let's say you've got, I don't know if you can see, well, we're on Twitter, so you can't really see, but let's just say that you've got Fed funds at 5.25%. And let's just say that the 10-year Treasury is trading at 4%. Well, a bear steepener would be the 10-year Treasury going higher and higher and higher and higher and higher and higher, let's say up to 6%, 6.5%. And the long end of the curve is going up while the front end of the curve is staying the same or going up at a slower pace. That would be a bear steepener. And actually, that's what signals the economy is healthy. That can signal one of two things. One, you're in runaway inflation, or the economy is actually running on all 8 cylinders, and therefore there's nothing to worry about. And why? It's because the banks are using that balance sheet capacity not to buy treasuries, but to take risks and to lend into the real economy. That's why the curve is steepening out. That's why the long end is going up. Now, the opposite is the bull steepener. This is when short-term rates go down faster than long-term rates. And this is the bad steepener. And that's the market, the Treasury market, telling you that the Fed is not only going to drop, but they're going to drop probably sooner, and they're going to drop more than you are expecting because the stuff is about to hit the fan. And going back to the Sahm Rule, going back to the uninversion of the curve, going back to the 1950s, not only has the inversion preceded every single recession, but the uninversion that we see every single time is a bull steepener. It's a bull steepener. And I mean, you see this all the time. You're in markets. You have heard the narrative for the last 6 months. Oh, the yield curve is dead. Don't look at the long-term interest rates. They don't matter anymore. And you've heard every excuse under the sun as to why this time it's different. Oh, this time it's different because the Treasury is going to issue so much debt because of the deficits and the debt that the long end of the curve is going to go up, and we're going to have a bear steepener. Or, oh, we've got reflation because of China, because of India. I mean, you throw in the excuse as to why this time it's different. But this time it's never different. It's never different this time. And that's exactly what we're seeing play out over the last couple of days, is all of this talk that we've heard about reacceleration of inflation and a reacceleration of the economy, and all this talk that we've heard about the long end crashing, meaning yields going up at the long end due to a bear steepener, is all, in my opinion, been completely debunked. It's been proven completely wrong when you just look at the price action of what's happening in the bond market. And to tell you how extreme this is, just today, the 2-year Treasury is down almost 30 basis points. 30. And keep in mind, this is after the market has had the opportunity to digest and price in everything that Powell said on Wednesday. So the 10-year Treasury, as you would expect, is down as well, but it's only down 17 basis points. So what does that tell you? That tells you that the 2-year Treasury is going down at a much faster pace than the 10-year, i.e. a bull steepener. The exact same thing that we have seen play out in every single cycle going back to the 1950s. This time, it's not different. It's never different. It's just that's always the narrative leading up to the stuff hitting the fan.
What about people say we're only 5% off the highs? This really isn't anything to be alarmed at. We're in an election year. Unemployment's generally low. Housing is very strong. We still have low inventory. Energy has been kept low, so we'll get that inflation back up as soon as energy prices go back up. So really, we have nothing to worry about.
Yeah, it's looking in the rearview mirror. So we're not looking in the rearview mirror. Look, setting up your portfolio is not about what's happening today. It's about what's going to happen tomorrow. And you could have made the exact same argument back in the first quarter of 2008. You could have made the argument in the second quarter of 2008. But you would have been wrong. Now you say, George, well, maybe that you're comparing apples to oranges. No, I'm not. I'm comparing apples to apples. Why am I saying that? Because all these other metrics that we just talked about are completely lined up. Now, if the curve was not inverted, if the Sahm Rule was not triggered, if unemployment wasn't, and the way unemployment works is just like bankruptcy. It's very, very slowly, then all at once. And it happens that way in every single cycle. And we're just starting to see that uptick. Like we said earlier, the Sahm Rule has been triggered. And all of these, and I'm just mentioning, this is just the tip of the iceberg. If you want to go and look at all the data, it almost all lines up the exact same way it did in the beginning of 2008. So you have all of this data that backs up what the yield curve is telling you. So my point there is, if we just had this isolated instance where the stock market was just down by 5%, and that's all that was happening, we had a steep yield curve, we had the unemployment rate wasn't going up, we didn't have all this other soft economic data. By the way, the jobs numbers, we haven't even talked about that. Jobs numbers expecting 185,000 and comes in at 114,000. And by the way, I can almost assure you the safest bet in markets today is betting that next month they're going to downwardly revise the establishment number, because they downwardly revise this stupid number every single time. Going back a year and a half, it's the most bogus headline number I've ever seen in my life. So there's a 99% probability that it's even lower than 114,000. So if all this stuff wasn't happening at the same time and we just had a 5% decline in the stock market, I'd agree with you. I'd say, yeah, it's like a nothing burger. Buy the dip. But you've got to look at the evidence. You've got to look at the data in totality. You can't just sit there and cherry pick the stock market.
We're going to go to the audience. We got questions. We got 312 people in. Make sure you retweet the room, retweet the space. We got George Gammon on. Joe Carlasari has a question for you. Joe, are you there?
Yeah, I'm here. Thanks. And I will start by saying, George, I agree with you that I don't think the rate cuts are in particular going to help the stock market. I think the stock market is well due for a correction. I happen to be expecting it for months now. I don't see why it's that crazy to think a 10% correction isn't perfectly healthy within a larger bull trend. Where I disagree with you is the signal you're taking from the bond market. Because if you go back and you look at March of 23, you had the 2-year fall 120 basis points on this imminent expectation of cuts, what happened? All of that got priced out. The 2-year sold off, as did the 10. We came within 14 bips, I believe, of the yield curve on inverting. And what happened after that? We had consistently sell off across the bond market for the next year, right, as yields went higher. So I don't understand why the notion that fears, particularly over which seem to have sparked from Japan, that that's going to cause some imminent recessionary force in the United States, given all of the other data, which shows generally robust consumption. Obviously, unemployment's ticking up higher. You have Powell saying that the labor market is coming to balance, which he means he's gotten to a level where he thinks it's appropriate to start taking the pedal off the gas with respect to future hikes. And it just seems to me like you're extrapolating from some signals in the bond market, which, to be honest, they've been broken for about 3 years now. The bond market was pricing in rapid cuts all throughout the end of actually 2022. Then they had 6 cuts priced in at the beginning of this year. All of them have been priced out. So, just because the bond market is, the bond market's wrong all the time. And you can go, look at historically how the bond market has priced in cuts in the 70s and the 80s, which never materialized and got priced out. They're just traders. They're human beings. So, all of these market-based signals are subject to vagaries, and they're subject to the fact that they can be, impacted in real time, and they're traders that are scared and nervous to a developing situation abroad. So I just don't get the conclusion that because of the fact that there's been a sell-off, or a bid of the bond market, and the yields have fallen precipitously, that means we're entering some huge recession. The other comment I'll make is, I think you're familiar with, and I know you cited the work of Lynn Alden, and she talks about how in the past there are real distinctions we can draw between bank lending-driven market cycles, bank lending-driven credit cycles, and what we have now, which is a fiscally dominant cycle where you have 6 to 7% of the deficit GDP being, government stimulus that is preemptively stimulating the economy, basically preventing the hard landing that you're talking about. And that's far more impactful, in my view, than rate cuts or rate hikes. You've got trillions of dollars stimulus built in, caked into the system, that are basically preventing the economy from falling into a hard landing that I think you were alluding to. So I'm interested in you taking any and all that, and feel free to disagree with everything I said.
Thanks, Joe.
The first thing is going back to, I think, the point the gentleman made in 2023 when you saw a significant bull steepener and nothing pan out. So I want to be clear. What I'm saying is that this is a signal that is becoming more powerful. But when you know that you've crossed that line in the sand is not when the curve is uninverting, but when the curve is uninverted and stays uninverted for a sustained period of time. So it's not, you can't sit there and say, oh my gosh, we've got this bull steepener, and therefore the end is near. You've got to say, okay, we've got a bull steepener that uninverted the curve, and we're not there yet. We're just getting damn close. And once it stays that way, a great example is the 2s and the 30s. So if you look at the 2-year, 30-year, it uninverted about 2 or 3 weeks ago. And I said on my channel, I said, okay, this could be a head fake. You've got to wait and see how this plays out. And then when it's most likely headed, or that's the trend, the new trend, is when you see it stay this way for 3 or 4 weeks and you see the delta increase, which is exactly what we've seen in the 2s and 30s. And if the 2s and 10s uninvert, which is my base case, I would expect you to see the exact same thing. So it would be different than what we saw, which, to be clear, the curve never uninverted completely back in, I think it was 2023. Next thing, he says all of the other data is strong. Dude, I don't know what data you're referring to, but when McDonald's comes out and says that Americans can't even afford a $5 value menu, when you've got the unemployment rate, which is really the only thing, the labor market was really the only thing that people had, as far as the bulls, to kind of hang their hat on. And now all of a sudden, the unemployment rate has gone up to 4.3%. And looking back at every single cycle, we see this is how it plays out. The unemployment rate starts to go up, and then it goes, boom, it goes completely parabolic. So I from what I'm seeing, most of the data has been negative, and especially if you look at the signals that the curves and the interest rates are telling you. I'm from the simple standpoint, there's nothing else recessionary that I can see. Well, how about the fact that the 10-year Treasury is trading at what we're trading at 3.8, let's say. So we're 150 basis points under Fed funds. How is that not the most bearish signal of all time? Do you say the bond market is always wrong? No, it's not. Now, if you want to sit there and say the bond market is wrong because inflation exceeds the rate of interest that you're getting on that Treasury that you're holding, okay, there's kind of an argument there. Obviously, if your expenses are denominated in dollars. But what I'm talking about is the bond market always being right is in future growth and inflation expectations. That's where the bond market is always right. And you go back to these inversions, it's never been wrong.
The 4.1% unemployment, it is at 4.1% after absorbing millions of immigrants that have come to the United States. So this is why Claudia Sahm, who you've been citing, she's explicitly saying, I think the Sahm rule is incorrectly triggered, just like the yield curve is incorrectly triggered. So again, this is the longest period where the curve has been inverted in history. We can agree on that, right? That's a fact. So the notion that this time isn't different, and you're saying that categorically, I think is pretty lazy, thinking, right? Because
so you're saying that this time it's different. It is just really incredible thinking. Like that's, my goodness gracious. You're very, very clever.
What was the last time we had this deficit to GDP going with 4% unemployment? Give me one period in U.S. history.
You said that there were 3 other times in history when the entire curve was inverted.
I never said the entire curve. You're adding language because you know I'm right.
Oh, give me an example. When, 95?
No, I'll give you the data because apparently we can't look up the curve. Hang on a second. I'll give you the 2s and 10s.
No, but I don't, Joe, to be fair, I don't think he's not saying that it's just due to the yield curve. It's the yield curve
it's everything
plus
else.
The Sahm Rule, plus Mickey D's, plus Starbucks, plus unaffordability, plus inflation.
Plus commercial real estate, plus the fact that M2 money supply has gone down, plus the fact that bank credit's flat, plus the fact that the Norin Chukin, you look at the liability side of these balance sheets and the dollar funding. I mean, I could go on and on and on about this stuff, but let's just focus on the first thing. Tell me when the entire curve or the curve has been inverted.
What
did
part
not
of the curve? You
show
want
me the
2s and
3
10s?
times.
Are those the ones you want?
Fun little debate between Joe and George.
But then let's while he's looking that up, let's go to another one of his points about all this quote unquote stimulus. Let's be very clear about government spending, especially in the long run. It is by no means stimulus. It's a sedative. It creates economic distortions that slow down the economy. I mean, think about what you're saying. You're saying that if the government spending is a higher percentage of GDP, then somehow that's a good thing, that's going to make the economy boom and reaccelerate. What?
I never said that. I never said it was going to boom and reaccelerate. You clearly have a bifurcated economy where you've got the haves and the have-nots. You've got low-end consumers that are struggling. Sorry, I was getting the data you wanted. So here's the data, okay? And you can look this up, okay? Yield curve, 2s and 10s, inverted briefly without any recession, 1966. They also inverted briefly 2s and 10s in 1998. There also was a brief inversion in 2002. So those are the ones that I referred to, okay? I can give you other tenors of the curve if you want, 2s and 30s. I can pull that up as well. But this data is publicly available. It's not like, I'm making it up on the fly. So here's the thing, the situations are different, right? I know there's the slogan, right? And we can all, respectfully think it's dangerous to say this time is different, right? There are signs, but there are real reasons why this time could come out in a material differently way than other times, right?
Yeah, I'm very curious to hear your explanation as to why the 10-year Treasury yield is trading 150 basis points lower than Fed funds.
Yeah, so here's why. Because ultimately the long bond traders believe that the Fed's going to get inflation under control, even if they have to trigger a recession. But they're
You mean a recession? Oh, what? A recession? I thought that was impossible. I thought this time it's different.
No, I first of all, nothing I'm saying says there can't be a recession, right? There can easily be a recession.
But then this time it's not different. But then what is different about this time?
Okay, sorry, I'm having trouble hearing. Maybe it's just a bad connection.
If you're saying that this is likely going, or this could lead to a recession,
Yeah, anything could happen,
then
right?
how
There's
is
a
it
1 in 5
different
chance of recession every year.
then how
That's
is it
historically
different
since the
this time?
1930s, right? So
But
saying a recession is coming is not a really bold call. It's like, yeah, there's a 20% chance this could happen. I mean, it's kind of like the question is, are we headed for an imminent financial collapse? You're drawing parallels with 2008, right? Which
no. Now you're now you're putting words in my mouth. I'm talking about using that as a comparison as to when the data was similar to what it is today. That doesn't mean that I'm saying that my base case is that we have a GFC 2.0. My base case is that the yield curve is not incorrect, that it's not different this time, and that we do have a recession. Then that's what this is all about. So I don't know that we're disagreeing on that.
Yeah.
We're not disagreeing on that.
I would grant you the 1960s, but outside of that, I would look at the entire curve.
I think the more alarming stat is the Sahm Rule being triggered. I know Sahm is not saying that it makes a difference this time, but there might be some reason she's saying that. But I've never seen, I'd be curious, has there ever been an instance where the Sahm Rule has been incorrect?
No.
Prediction. And I think that's the point. Joe, you're making the point of, hey, the yield curve inversion doesn't always equal recession. And I think.
But it's preceded every recession.
Yeah. But George is saying, well, you add in the Sahm Rule to that, it is way more likely. And
everything else. And let's not forget, we're in the middle of
when you're making a forecast, right, you should assign probabilities. And the greater weight of the evidence should inform that forecast. That's just basic analysis, right? In a Bayesian way. Now, what I would say, though, is that...
No, but the point is nobody knows what the hell is going to happen. Nobody knows what the hell is going to happen in 3 to 6 months.
But based on the data, the probability is skewed heavily toward a recession. And this time not being different.
Yeah. I mean, I think that's fair. But, for people to come up and say it's like a guaranteed or certainty, that's the dangerous part. And let's talk about right? One of the reasons Claudia
I don't think he was saying guaranteed. I think he said it was likely. I would also challenge, what is Claudia Sahm's political background? I mean, when you do these things in an election year, some of these people.
Let's address the Sahm Rule being incorrect because we have all this immigration. This is, look at the 1970s. The Sahm Rule was correct throughout the 1970s, and look at how many people we had entering the workforce then in terms of women. So if you want to make the argument that this time it's different because we have more people entering the workforce, well, you'd have to completely ignore the 1970s.
I also don't necessarily trust when some of these people come out and try to dampen the bad news. So the Sahm Rule is big. I'd be curious if anybody has any historical data where the Sahm Rule wasn't accurate, because
it's 100% accurate.
I've never seen it not be accurate.
It's 100% accurate.
Yeah. So far, it may not be in this
absolutely
instance.
And this is and to grant the caller, to give credit where credit is due. I say this on my channel constantly. There are no certainties. There are only probabilities. Absolutely. I never, ever, ever talk in certainties. And if someone listening right now or on one of my videos thinks that when I'm mentioning, I'm saying this as 100% probability, absolutely not. Absolutely not. I'm saying this is my base case, and I think the probabilities are extremely high that what we are seeing now is not different. And that if you go back in time to the 2008, if you go back every single cycle, it's always different, and they give you a different reason. Back in prior to the GFC, it was because, this time it's different. The yield curve, it's fake news because this is all about housing, and we know subprime is contained, and we know the housing market isn't going to affect the global monetary system and the banking system, and we're only going to have the default rate go from 2% up to 6%, and we don't have to worry about these mortgage-backed securities and blah, 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 blah. And therefore, the bond market is off sides. Well, look, there's always a reason why you can say this is an apples to oranges comparison. But every single time, looking back in retro, well, not every single time, 95% of the time, looking back in retrospect. And I'd like to, and just briefly there, 1960s, he's absolutely right about that. And the reason why I always include that is because GDP growth went down to such a massive degree. I don't know the statistics right off the top of my head, but we had real GDP growth go down from like 8% down to like a 0.2 or something like that. It went down to such an extreme that it might as well have been a recession.
So let's break down the jobs report. Talk about the jobs report for a little bit. Kind of changing gears here.
Yeah, I mean, first of all, we've got to differentiate between the establishment number and the household number, right? And the household number has been in recession mode, let's say, for quite some time. And I just did a story today about how the establishment number coming out and was not only piss poor this morning, but also the household number was extremely poor as well. But what we've seen, like I was saying earlier in the stream, is I don't know, not every time, but 90% of the time they have come out with this higher than expectations as far as the establishment number. They've revised it down the next month. It happens over and over and over and over and over and over again. So let's assume, and again, there's no certainties here, but if we assume that the number was 114 today and they're going to revise that down, keep in mind the expectations were for 185. And that's what took the unemployment rate from 4.1 up to 4.3. So let's assume that they come out and revise it down next month. Well, that takes the unemployment rate up even higher. And show me the time when we've had the unemployment. I mean, if I had a chart right now and you look at how just pull up a Fred chart of the unemployment rate and look at it in regards to recession, you see it play out every single time. How it gradually goes up and then boom, it goes completely vertical. So I look around and I say, why would this time be different? And I can't see any argument that I think is credible as to why it would be different and why the bond market would be buying I mean, look at this. Think about the issuance we have had since 2019 as far as treasuries. Just let that one sink in. And just to be clear here, as far as data, in 2019, the U.S. debt was 22 trillion. Today, it's 34. It might have even gone over 35 trillion. 35 trillion. So we have added, think about that, $13 trillion worth of treasuries in the last few years. And the 10-year treasury is trading at 3.8.
What's the maturity profile on what's been issued? You know?
Who cares? Think about.
It matters in how Janet Yellen decides to fund
worst.
the government.
No, I think it matters.
If
I've
she's
heard
funding a short-term paper, why would it's basic supply and demand? Why would 10 years move if no 10 years are being issued? And what we know about the maturity profile is that the average maturity is 6 years. That's the data. Okay, so she's not issuing at the long end. So there's a dearth of supply. Basic economics, small e economics.
But it still goes back to growth and inflation expectations. And if growth and inflation expectations were higher, the interest rates.
Supply argument, supply matters, which is what you just did.
No. I'm not making a supply argument for interest rates being where they are. I'm saying in spite of all the issuance that we've had throughout the entire curve, we still see the 10-year trading at 3.8%. I'm not
issuing 10 years. Why would they go up? You're not getting any supply there.
Because if we were experiencing growth and inflation expectations like what you're talking about, that the economy is running on all 8 cylinders, that the economy is on fire. Look at the you said at the beginning of this. You said look at all of the data.
They're well anchored, and you've got growth expectations in the high 2s. So where's the 10-year at?
The 10-year. Again, let me be clear. The 10-year is trading 140, 150 basis points under Fed funds. That's not telling you
it's above real GDP, right?
No, but look, that's not a prediction as to where interest rates should be. What that's telling you,
it's based on growth.
No.
Interest rates are reactive to growth. You just said that. I'm quoting you.
I'm talking about the trend. I'm not talking about
the
the
higher nominal growth due to excess fiscal spending driving
No.
up rates.
If the trend was
what's baked into the market right now.
Look, if the trend was higher, you wouldn't see the 10-year Treasury going from 4.3 down to 3.8. If the trend in future growth and inflation expectations was higher, you would not see that price action in the Treasury market. You would see the opposite.
Why not?
You would see the bear steepeners.
No, because you're seeing, I'm telling you, as someone who manages money.
5%, and then it gets bid.
No, but as someone who manages,
we're the higher floor.
Right. I'm not saying that you can confirm this yet. I'm not saying that you can, ride off into the sunset and say, oh, yes, the yield curve was 100% certain. Again, you're not going to be able to tell that until hindsight is 2020. I grant you that. I absolutely grant you that. But what we're seeing would lead you to believe that the probabilities are high that we're going to get that inversion in the 2s and 10s, and it's going to be sustained. It's going to be sustained, and it's going to play out regardless of where the issuance is. And my point is, if you were correct and that the probability was low, that we're going into a recession, and this is just fake news and it's different this time, you would see you would not see the 10-year going from 4.3 down to 3.8. You would see the trend in the opposite direction.
Yeah, exactly. Because you're seeing a flight to safety. You're seeing with
people.
Let me say something.
Didn't we see the exact trend reversal in March of 2023, where the 10-year fell, the 2-year fell 140 bips in a day or two, or actually 4 days?
That could happen. Could happen again. That could be. I mean, I don't think he's disagreeing.
So again, it could go. We could.
I
see
think there's
two
two different arguments
the
here.
Yield curve could continue to invert.
Yeah,
and we could be
let
6 months
me
from now,
talk. Hey,
10 years bearing down at 5%, and then what will George say? Then we're still on the verge.
I mean, I'm telling you right now, as somebody who manages money, people are scared.
Let me let everyone know when George Gammon is wrong, because I've stated this on my channel as well. I say when I will sit there and wave the white flag and admit that this time it's different, it's when we get a complete bear steepener, sustained, not just a bear steepener, but when the curve uninverts as a result of long-term interest rates going higher than short-term interest rates. If we get that move that's sustained and gets more and more extreme as far as the delta, I will be the first person to wave the white flag and say I was wrong. But as long as
I got to go. But thank you so much for your comments. I'm sorry to give you a hard time. I appreciate your work. Thank you, Josh.
No, I appreciate the pushback. I appreciate
Thanks,
the pushback.
Joe.
Thank you.
I wanted to hear your perspective. Here's my perspective, just as somebody who manages money, which people don't. This is kind of a different take. Joe is a master litigator. I don't know if you know Joe. He's a big Twitter following. George, make sure you follow Rebel Capitalist. He's great. And I love that we could have you on with Joe, kind of giving the bullish take, and you're giving the bearish take.
It looks steel sharpens steel.
Yeah. So
right? The last thing I want to do is be in an echo chamber of people that just agree with George Gammon.
Yeah, I love he's more in the bullish camp a little bit, but I think you both agreed that there's a probability of a recession to some degree. So yesterday morning, we made a massive purchase of 2-year treasuries. Massive. We had cash sitting on the sidelines. We flipped it. We bought, I think, 4.2. I got it at 4.2 for we bought about $39 million worth of 2-year treasuries. Because I just said, hey, I'd rather park it. I think, and this would be a bearish case, I think a lot of people managing money made the same decision. I think the move that we saw yesterday and today said, hey, I'm not going to wait for rates to go to 2% or 0% anymore. I'm just going to lock in 2 years for my clients, have them be happy. That, to me, is a very bearish scenario.
That's why the curve uninverts, because the curve isn't magic. It's just a representation of what market participants are doing, just like you.
And the 10-year is distorted, I think. The 10-year is a different distortion. I want your comment on this. A lot of people talk about the 10-year being so important, and it is. But to me, just from people I know who manage bonds for annuity companies, insurance companies, one of the biggest buyers of bonds in the world is U.S. bonds, are insurance companies, institutions, pensions, annuities, things like that. Those people always buy 10 years. So I think sometimes there's always demand, because if you buy a 10-year annuity or a 7-year annuity or a 5-year annuity or a pension, they're generally priced off the 10-year. How does that distort things now with all these people retiring? Have you done any research on that? I've never.
But let's walk this one through though. So you're a pension fund manager, all right? And the CPI, let's say, is printing 9%. And you think that we are headed for 1970s type inflation. Are you going to buy a 10-year at 3.8%?
No, but I think they think we're headed to a recession or lower rates, so they'd rather lock in 10 years at 4%.
That's exactly what I'm saying. That's exactly what I'm saying. That's it. That's what the yield curve is telling you, that the insiders, the financial insiders, would much prefer to own a 10-year Treasury, or I'm just using that as a proxy for long end of the curve, because they want the juice, right? They want the juice that they're going to get from duration.
Yeah.
So that's why they're going as far out the curve. So they're going into safety and liquidity instead of taking that balance sheet capacity and taking more risk. Why wouldn't they do that? Look, if the economy was doing well, if there was a very low probability that we have a recession, why wouldn't the financial institutions, and I throw banks in there and banks outside of the United States, in the Eurodollar market, why would they not be taking that balance sheet capacity and better utilizing it to get a higher return by creating, let's just use banks for an example, by creating loans in the real economy? Why wouldn't they be doing that? The reason is because the risk reward doesn't make any sense, because they've got the boots on the ground intel that is showing them that the economy is doing very poorly and likely headed for a hard landing. Therefore, they take that balance sheet capacity and they buy the long end of the curve. Now, would they buy that long end of the curve? Let's just say his argument was low supply. Okay, fine. But even if there's low supply, if growth and inflation expectations are for 8, 9, 10% and going up higher, there's no, regardless of what's happening on the supply side of the equation, you would not see the 10-year trading not only at 3.8, but going down from 4.3 straight down.
Let me just jump in here. Do you guys think that the case for that is I think somebody alluded to it earlier. It's just investors front running the Fed. I mean, the Fed has signaled that they want to cut. They want to cut, and everybody was expecting a cut even as early as this week. Now everybody's expecting a cut in September. So of course, I think that's what's going to happen, right? Everybody's kind of front running the Fed. But I want to ask you guys, George, what part of this has to do with the Fed's balance sheet? I mean, if you look at the balance sheet, I think just this week, the balance sheet reduction is like the largest on record. Last I looked, I think we're down somewhere like in the vicinity of like over 20% from the peak in 22. So,
right. What are yields doing, by the way?
Yeah. So, I mean, the opposite. Right. And going back to the Sahm Rule, I mean, it's a rule, right? I mean, everybody's panicking today. Like it's triggered, like it's a light switch. We're going to have to look for revisions over the next few weeks and see, if there's any green shoots. I mean, I wouldn't jump to conclusions. I think everybody, we are prone to jumping to conclusions these days. There's just a lot of information floating around, a lot of misinformation, I think, floating around. So, I think while I think things are slowing down, I mean, look, consumer confidence came out. What was it? It was like shooting the lights out. People are still spending.
If the economy was doing so well, you wouldn't have bank credit flat. You wouldn't show me the time when M2 money supply has gone down over a 2-year period, and we haven't been in not a recession, but a Great Depression.
I think Joe was comparing, you guys were, 15, 20 minutes ago, you guys were comparing different time points, 70s, 80s, 90s, 98, 95. I personally, I throw all that stuff out the window. We're living in an age now where it's very difficult to make comparisons to past history. I mean, I think it's just, it literally is idiotic to think that we can make comparisons today going back to like the 90s. I mean, it doesn't make any sense.
But then why aren't these entities that have the boots on the ground intel lending into the real economy? Why? Why are they taking that balance sheet capacity and going out and buying the most safest liquid asset if the return isn't as good?
I've been harping out for a long time. The banks have had no incentive to really lend money into the real economy.
How about greed?
Since the GFC.
But why not? How about greed? Why would they not want to get that higher return?
Because I think it's just easier to do business with the federal government than it is to do business with boots on the ground, with businesses and
But look, if you can get a 2% interest rate increase by doing business in the real economy, then with the Fed, you're going to do that. You're going to do that why would you not do that if you're a bank? That's your business, for heaven's sakes. The fact that they're not doing that tells you everything you need to know about the health of the economy.
Well, I think everybody's on pins and needles. You're right. I think, and that's, that's accelerated. By the way, a lot of it is just we talk ourselves into a recession, right?
No.
It doesn't just happen. It's if we talk about it enough and we scare enough people and we scare ourselves, then we kind of just talk our way into one.
This is nonsense. This is the argument that the middle class America out there that's honestly struggling to put a roof over their head, that's struggling to put food on the table, that's seen their purchasing power decline massively since 2019, just needs to suck it up and realize that you don't know how good you got it, and just get out there and spend all your money, and then we don't have to worry about this recession thing. But come on.
Look, the economy seems to be, based on the data that came out in the last week and a half, seems to be okay. It's not great. It's okay. The Sahm Rule, again, it's a rule. What are your thoughts on the idea that, we are probably going into a slowdown, but the Fed is kind of up against the wall because, I think the Fed is fighting an uphill battle here. They brought down the balance sheet so much. They've tightened money supply so much. You referred to kind of M2. So on one hand, they're doing one thing, and on the other hand, they're doing a complete opposite thing. And here we are kind of in the middle. I think we are literally headed down the path of stagflation. I don't think they can raise interest rates with inflation. And you alluded to it earlier. You guys talked about it, right? The high prices that we're all paying. Let me give you guys an example. Just this week, I was going to put a pretty lengthy post out. I might do that this weekend, about insurance. So let me give you an example. I'm in California. I just got my, and I didn't even know this, by the way. This is really what these insurance companies are really sneaky. So my insurance renewed, my automobile insurance, auto insurance renewed in May. I didn't know it renewed because it's on autopilot, just gets paid until I called them this week because I just was curious. I've been hearing about, all these people talking about insurance premiums going up. So I was curious, like if ours actually went down maybe, because my wife and I are perfect drivers. We have a teenage son. Both of them now are new drivers. Nobody's had a ticket, no accidents, no nothing. Pristine record, everything. Perfect. We are like the perfect customers for these insurance companies. So I called and they said, we put you guys, first of all, you didn't get the update because it's going into your email. We don't send out paper statements anymore. And that was something we changed last year. I said, I would have liked to have known about that. So somehow it got into my email, and I never even bothered to look because we get a lot of junk email like many of you. So I happened to look. I talked to a person at the insurance company. Here's what they told me. First of all, they started out by saying, listen, you guys have been great customers for a very long time. We appreciate the business, this and that. And I said, listen, let's cut to the chase. Did my premiums go down last year? We've had no issues, no claims in years. The cars are a year older now. They should have probably at least gone down a little bit because historically they would go down a little bit, right? So here's what happened. Okay. She said not only did they not stay level, they went up 30%. 30%. That's how they thank good customers like ours. Now,
no, that has to do with PNC is an industry all its own with
everything, healthcare insurance, automobile insurance, not to mention home insurance. It's going.
Here. I want to get to George. He might have to go soon, so I want to. He's been very generous with his time.
About this earlier, but so you're getting push and pull from a lot of different angles, and I think we're headed in.
But that's another bit of negative news. Property and casualty insurance companies, they don't raise rates, by the way, to screw you around. They do it because their losses are more. They're combined. There's metrics
in claims for wildfires
here
in California. So what are they doing? AAA, by the way, what they did is they
real quick. I want to hear from George O'Hare. Go ahead, George.
Okay, so I'm sorry, but how much did your insurance rates increase?
30% year over year.
30%. Okay, so let's just say this is actually deflationary. And let me tell you why. because when you get short-term increases in inflation without a corresponding increase in the money supply, then you're robbing Peter to pay Paul. And eventually those higher costs are going to lead to deflation because you've got to take that purchasing power away from something else. So let's just say that 30% increase in your insurance represents $1,000 a year. Okay, that's $1,000 that you're not going to be able to spend at Walmart, Home Depot, Chipotle, Target, etc.
You're seeing that. You're right. Look at the number you just mentioned: Starbucks, McDonald's, a lot of these places, which we don't usually go to. But
right. So what people have to do is they have to prioritize the stuff they need, and they have to forego spending on the stuff they want. But then what happens is all the companies that provide the stuff you want have to start firing employees, and as a result, aggregate demand goes down. When aggregate demand goes down to a point, it actually starts to influence the price of the stuff you actually need. And then those prices go down. And then we come in with a response from the government, which leads to likely higher consumer price inflation after we go through that disinflation or deflationary period. Look, my base case is absolutely, we will see an inflationary decade in 2020s. But it's always a roller coaster ride. And I don't think it's going to be like the 1970s. I think it's going to be like the 1940s from the standpoint where you have these huge swings between consumer price inflation, disinflation, and then outright deflation. I mean, I was just looking at a chart when you were speaking there, and going into 2008, the CPI, and I don't know if this chart is too accurate, so you'll have to fact check me on this, but the CPI was higher than it is today. And then, as you guys know, in 2009, we actually got a quarter, I think it was Q2 or maybe Q3, of outright deflation.
I think we're going to have that. I mean, if you think about in past history, if you look at how stable incomes were, for example, minimum wage, just in the last 3 years, minimum wage, all across America has gone up exponentially. Look at California. We have
but you could say as a counter to that, companies are now going with AI and they're going to replace the minimum wage worker with a robot.
If the guy at McDonald's making your cheeseburgers making $20 an hour just worked that way up to skilled labor, up the food chain. So those price increases we still have not seen.
A robot's going to be flipping the burger. And therefore, that's going to decrease the aggregate demand, and that just exacerbates the problem that I'm talking about.
Yeah, they're going with robots.
At a certain point, the margins for these businesses can only shrink to the point of almost zero before they have to start laying people off, firing people. You can't just have wages keep increasing and increasing and increasing into infinity and beyond if you don't have the banks lending, creating more currency units, and therefore creating more money supply that leads to the 1970s when you see the money supply going up in a straight line, or else you're robbing Peter to pay Paul.
Anything you wanted to talk about today that you didn't talk about?
I mean, I think that's it. The back and forth that we've had has been fantastic, and hats off to these gentlemen that have made some very, very valid points. I disagree with them, but I think they've made valid points, and they've allowed the audience to hear both sides of the story so that they can make their own decisions on what their base case is, again, based on the probabilities and not certainties.
Yeah, and I think the Sahm Rule is just, I remember one time I first heard about it through a guy, Stan Hartley. He was running all these charts, and he had his own rule that was very similar to the Sahm Rule. And he went back to through 100 years, and he said that this.
Yeah, and if that was it, and that's if that was the only thing. Let's keep in mind, you've got to combine that with everything else that's going on. And one of the one thought experiments that I rarely ever see people do, is if I would, let's just say for a moment, we go back in time to 2019 and we're doing this interview, and we don't know what's going to happen in 2020. And let's just say, I say, a question for everyone listening right now. If the government locks everyone in a cage for 2 years and destroys global supply chains and shuts down the global economy for 2 years, do you think that will lead to a recession? Most people would say, hell no, it would lead to the greatest catastrophe that we've seen since it would make the Great Depression look like a picnic, for heaven's sakes. So if that was your base case, or if that was your opinion, 2019, what has changed? What you're saying that, well, we're just going to get out of this scot-free, that we're going to shut down the economy, the global economy, for 2 years, and just because we hand out some stimmy checks and some PPP loans, then that's going to solve all the problems, and we're never, ever, ever going to have that recession or Great Depression, and it's just off to the races. That we've somehow found this magic formula to economic growth, and that's locking everyone in a cage for 2 years. When you think about it in those terms, it's like, yeah, obviously at some point in time, we're going to have to pay the price for all of those economic distortions that the government created. And we've been paying the price as far as lower purchasing power because inflation has exceeded the rate of income growth for most Americans. But it's also, at a certain point, you're likely, and again, no certainties, but you're likely going to have to pay the price in the form of negative real GDP growth.
What investment theses do you like for the next 12 months?
Yeah, I can just tell you what I did yesterday. In fact, I've got a model portfolio for my community, and in the model portfolio, it's gold, T-bills, and I was taking the interest from those T-bills, and I bought call options on the NASDAQ. That was back in April, and I sold those a few weeks ago when we had that soft CPI print come out, and the NASDAQ took a nosedive because that invalidated my thesis. So I'd made a lot of money on that, thank goodness, and I sold immediately when the price action went the wrong way. And today, the price action that we've seen in the bond market since now, if we've seen this price action or the yield action when Jerome Powell was talking, that would be one thing. But we're seeing this after everything he said has been priced in the market. So then what I did is I looked at call options on the TLT, and I saw that they were pricing in, effectively, they were pricing in about a 1% chance that the 10-year Treasury, the long end of the curve, would go back down to where it was in 2019. About a 1% chance. And I said, I think that's completely wrong. And so I went ahead and I bought a substantial amount of calls on the TLT yesterday morning. And so far, knock on wood, that's been a big winner. I've got gold, and I always have gold. I want to make sure I say that I always have gold. That's the starting point in the portfolio, and we got the gold, the T-bills, and then we're going back and forth with these call options. But that's just me telling you what I'm doing with my own
not
portfolio.
giving any investment advice. Just curious to know. Thank you so much, George. Follow him, the Rebel Capitalist. Subscribe to his YouTube channel. Follow him on Twitter. Retweet the space. And thanks for joining us, George, as always.
Thank you for having me, and thank you to the people that were pushing back on my hypothesis. I sincerely appreciate it.
You notice they didn't give, though, I will tell you, they didn't give much of a bullish case. Like there
no, you keep pushing them, and we're like, well, yeah, we're kind of headed for a recession, but this time it's different.
Yeah.
not to poke fun at it.
I think people fundamentally believe that the government kind of undergirding that bullish case is that the government will do whatever it takes to not have the thing break. Stimmy checks.
Yeah.
They'll helicopter money,
I totally agree with that. I'm just talking about they're always behind the curve. And I don't think they're going to do that until, pardon my French, I don't think they're going to do that until it's the fan.
Yeah, until after something breaks, which something may have broken this week.
That's right.
Thank you so much. Everybody follow us and follow the room. Follow me. I'm your financial QB. If you like what you're hearing, we have a lot of great guests on. Thank you so much. Take care.